How to make money by trading in a recession. David Jaffe with BestStockStrategy.com, and in this video you are going to learn how to consistently earn money in all trading environments. In December 2019 and January 2020, the stock market was going up virtually every single day. I'm sure that many people were bragging about buying calls in Tesla and making a tremendous amount of money. The problem with these situations is that the market has a tendency to take the stairs up but jump out the window on the way down. And we saw this in late February and March of 2020, where the market is now down 20% off its highs, and officially the bull market is dead. The best way to protect yourself and to make money consistently in the market is to be patient and disciplined. In January and February of 2020, when volatility was extremely low and the VIX was trading at about 12 or 13, we were entering trades very infrequently. We were only making about 1 to 2 trades every single week. And because the VIX was very low, we were entering all trades as vertical credit spreads. By entering your trades as a vertical credit spread, you are inherently protected because it is a defined risk trade. Additionally, because we did not enter too many trades, we had about 70 to 80% of our account available as buying power. So the most important thing is that you always have to be patient and disciplined. Ignore all the other people who are telling you that they're making money by buying call options, by day trading, by trading penny stocks, by trading Forex, because over time, every single one of those people are going to lose money. Day trading, trading penny stocks, trading Forex, buying options has an expected outcome which is negative, and it's only a matter of time where you're going to lose money by doing that. The best way to make money consistently is by selling option premium. However, when the market corrects 20% off of its all-time high, and it does so extremely violently like it did in late February and March of 2020, the best way to protect yourself is to make sure that you trade vertical credit spreads. Now, I made a big mistake. During the first week of March of 2020, what I did was I rolled the vertical credit spreads to naked options. When Lockheed Martin fell to around 380, and the market went up 2 days in a row, I thought that the market had stabilized. So what I did was I rolled that vertical credit spread into a naked position, and then I ended up losing money this past week. These losses are probably going to cost me around 2 months worth of trading. So it's not the end of the world, but at the same time, I did make a mistake. Previously, I thought that I would make money from this sell-off, and I was positioned extremely well where I would make money. However, this past week, I did close out the position in Lockheed Martin. I did not want to hold onto the position over the weekend, and as a result, there is an extremely high probability that this upcoming week I will reset the position, but I did make a mistake by rolling from a spread to a naked option too early. The advantage of trading vertical credit spreads during low volatility times is that it protects you against large sell-offs and volatility expansions. However, when you roll a vertical credit spread to a naked position, you had better make sure that the market has stabilized, and this was a mistake that I made. If I had another opportunity, I would have simply rolled the vertical credit spread forward. I would have waited for the market to provide me with increased assurance that it had stabilized. So for example, I would have simply kept the Lockheed Martin trade as a vertical credit spread. It was $22.50 wide. I could have rolled the 407.5 short put to a strike price of around 402.5. I could have then rolled the 385 long put to a strike of 380, so I would have maintained the same $22.50 wide credit spread. I would have been able to receive a credit for that roll, and then when the market had provided me with increased assurance that it had stabilized, I could have then, at that time only, rolled it to a naked option with a strike price of around 350, and I would have been able to roll it for a credit. So remember, in this situation, we win virtually every single one of our trades. The only way that we lose money is during a situation where the market has an extremely violent sell-off and it also has a very large volatility expansion. During this situation, you want to make sure that you always maintain adequate buying power. By leaving adequate buying power, you are not going to make as much money as those people who are buying call options during a bull market. However, on the flip side, you will be substantially protected from a violent sell-off, and you will actually make money from these situations once volatility contracts, as opposed to losing money. So remember, if you want to be consistently profitable in all market environments, you have to learn how to be patient. You have to learn how to be disciplined. Now, even myself, who in 2019 had 0 losing trades the entire year, during the first week of March, I rolled too early. And by rolling too early, that is going to cost me about 1 or 2 months worth of profits. So again, remember, when you trade, you are not guaranteed to always make money. And even though we win virtually 100% of our trades, you have to make sure that at all times you protect yourself against a violent sell-off and a large volatility expansion like we have experienced over the past 3 weeks. 3 weeks ago, the VIX was trading at about 13 or 14. Recently, this past week, the VIX hit a high of about 76 or 77. I believe that right now, as of March 14th, 2020, the VIX is currently trading at about 65 or 66. Remember, we do not want to gamble. You are an investor. You are not a gambler. Again, you are an investor. You are not a gambler. And the best way to consistently make money in all market environments is to trade spreads during low IV environments, to be extremely patient and extremely disciplined when entering new trades, to make sure that you're okay with foregoing 2 or 3 or 5% returns so that you can actually make money during a huge market sell-off, as opposed to always playing defense and losing money during large market sell-offs. Now, there should not be an expectation of perfection. Even myself, I rolled too early, and that is going to cost me 1 or 2 months worth of profits. However, even losing 1 or 2 months worth of profits allows me to substantially outperform the overall stock market. So to recap, you have to make sure that you're patient and disciplined. You have to make sure that you only trade vertical credit spreads during low IV environments. You then have to wait for the market to stabilize. And then, and only at that time, when the market has provided you with adequate clues that it has stabilized, should you at that time roll your vertical credit spread to a naked position. Now, there are some other things that you can do. For example, if you had a $22.50 wide vertical credit spread in something like Lockheed Martin, and you wanted to substantially reduce the short put strike, instead of having a $22.50 wide credit spread, you could potentially roll it forward in time by about 2 or 3 weeks to a $25 wide credit spread. As a result, your maximum loss will increase from $22.50 to $25. Then, by expanding your maximum loss by only $2.50 from $22.50 to $25, at that time you might be able to then reduce your short put strike from 407.5 all the way down to around 360. In that situation, you would sell the 360 put and then you would buy the 335 put. At that time, once the market provides you with adequate clues that it has stabilized, you can then roll that vertical credit spread with a 360 by 335 vertical credit spread all the way down to a naked position with a strike price of around $330. David Jaffe with BestStockStrategy.com. You can visit BestStockStrategy.com if you want the absolute best information on how to be consistently profitable in all market environments. Remember, this is not complicated. We win virtually 100% of our trades. And the best way of doing that is by being patient, being disciplined, trading vertical credit spreads, making sure that at all times you always maintain adequate buying power, taking advantage of high IV environments, and only selling naked options when you're positive that the market has already stabilized, and by adequately rolling and managing your positions so that you give yourself enough time for your trades to be right. Additionally, if the market continues to sell off, we will begin selling the rallies by selling call credit spreads during days that the market rebounds. This is one of the best strategies that you can implement, and this is the best way that you can be consistently profitable in all market environments. Leave a comment below and let me know your thoughts. Also, leave a comment and let me know if you have any questions about being profitable during a violent sell-off. David Jaffe with BestStockStrategy.com. Remember, you must be disciplined and you must be patient. You can easily earn anywhere from 30 to 40% every single year while also winning virtually every single one of your trades. However, the real enemy is you. You are your own worst enemy if you do not patiently and with discipline only enter the best trades. If you decide that you want to get greedy and you want to buy options and you want to try to hit home runs, then I guarantee you that you are going to lose money. You have to make sure that you only enter the best trades. You trade vertical credit spreads, especially in low IV environments. You wait for the market to stabilize, and then you can take your vertical credit spreads and roll that position to a naked option. And you also have to make sure that you maintain and leave adequate buying power in your account so that you can make sure that you withstand these violent sell-offs along with a large volatility expansion where the VIX expands about 5 or 6 times. Again, David Jaffe with BestStockStrategy.com, and this is how you can trade and be profitable and become a consistently profitable investor in every single market environment.